The headline is simple and it OSS designed to punch you in the gut. They are panicking. U.S. government spends 7.4 B to secure silver before it's gone. But I want you to do one thing before your brain runs straight to the comments section. Pause. Because this isn't a story about a number, it's a story about behavior. And when you learn to read behavior, you stop getting played by headlines. Governments don't move like traders. Traders chase price. Governments chase certainty. A trader asks, can I profit? A government asks, can I guarantee supply? And the second a government starts putting real money into critical minerals processing on home soil, it's an admission that the old system, global, frictionless, always available supply, is not trusted anymore. That matters for silver because silver isn't a luxury, it's a requirement. It's one of those materials that quietly sits inside the modern world like a hidden skeleton. You don't notice it until it's missing. Then suddenly nothing works the way it used to. That's why this story hits so hard. Because it suggests we're crossing a line from markets to security, from trade to control. Now, let's strip away the drama and get precise. The core claim is this. A massive multi-billion-dollar U.S. critical minerals processing build-out is underway, and it's being framed like a strategic move to secure key metals. Even if you don't care about the details of smelting or refining, you should care about the direction, because the direction is clear. The United States wants the middle of the supply chain, the processing layer, inside its borders, and that is where power lives. Mines dig rock. Processing turns rock into usable, high-purity material. If you don't control processing, you don't control the metal. You control dirt. And dirt doesn't power the grid, doesn't run data centers, doesn't build advanced electronics, and doesn't win wars. Refined material does. Here, that's the part most people miss. This isn't just about more supply. A facility like this is about more control. It's about creating a pipeline that can be prioritized during stress. And it's about making sure that when the world gets messy, and the world is getting messier, your industry and your defense needs none until you get outbid or cut off or delayed. And once a country starts thinking that way, the market changes. Because supply that used to be available to the open market starts getting locked behind long-term agreements, strategic allocations, and private channels. The metal doesn't disappear from the planet. It disappears from the spot market. The tradable float gets smaller, and when float gets smaller in silver, one of the most paper-traded metals on Earth, you get the perfect recipe for a split reality. The screen price does one thing, while the physical market behaves like a completely different universe. So today I'm going to give you the real framework. Why processing is the choke point, why governments move when they fear a bottleneck, and why this is the kind of story that can quietly set up a violent repricing later, after the headlines have moved on. And let me be crystal clear, this is not financial advice. Silver is volatile. Leverage can destroy you. This is education. It's about understanding the machine that moves resources when the world is under stress. Now imagine you're a defense planner, or you're running a national grid upgrade, or you're building out advanced manufacturing capacity. You're not thinking price, you're thinking delivery, you're thinking purity, you're thinking volume. You're thinking, what happens if the shipping lane gets disrupted? You're thinking, what happens if export rules change? You're thinking, what happens if a rival nation decides certain inputs are strategic and starts holding them back? Those are not hypothetical questions anymore. That is the new normal. And silver sits right in the middle of this new normal because it touches two worlds at once. It's an industrial input that also behaves like money. That combination is rare and dangerous for anyone trying to keep the price stable, because industrial demand doesn't care about sentiment. It cares about function. If the system needs silver, it needs silver. The demand doesn't vanish because a talking head said overbought. And when nations start building domestic processing capacity, it's a signal that they expect demand pressure and geopolitical friction to persist long enough that the investment is worth it. Now, in part two, we're going to zoom in on the most important concept in this entire story. Why the out and midstream matters more than the mine, more than the ETF, more than the daily candle. Because the midstream is where metal becomes strategic, and where the squeeze can become structural. If you want to understand why this headline is so explosive, you have to understand one simple idea. In a fractured world, the most valuable thing is not the commodity. It is control over the process that turns raw material into usable supply. That process is the midstream, smelting, refining, separating, producing consistent, high-purity outputs at scale. And that's exactly why a multi-billion-dollar processing build-out is a bigger signal than any single day on the chart. Most people think supply means mines. Just open more mines. But silver doesn't work like that. A huge portion of silver supply is tied to other metals. It shows up as a byproduct. That means you can't just decide to mine more silver next quarter because price went up. Supply is slow, sticky, political, and it's vulnerable to one thing most traders never price properly: bottlenecks. Not in the ground, in the pipeline. When a government funds or backs processing, it's admitting that the pipeline is a vulnerability. It's admitting that someone else controls too much of the midstream and could tighten the tap during a conflict, a trade dispute, or a crisis. And here's the uncomfortable part. Once processing becomes strategic, the output behaves differently. It stops being available to whoever bids. It starts being reserved, directed, prioritized. Not always openly, often quietly through contracts and allocations. This is how a market transitions from price discovery to supply discovery. Price discovery is the world of charts. Supply discovery is the world where you find out whether the metal exists, where you need it, when you need it, in the form you need it. And supply discovery is always brutal because it reveals that a lot of what the paper market trades is just claims and assumptions. Now think about what a processing fortress does. It creates a new gravity well. It pulls concentrates, ores, and feedstock into a domestic loop. And once that loop exists, the country can say, we don't have to compete on the open market at the worst possible moment. We produce and allocate internally. That is the strategic logic. It's not about tomorrow's price. It's about removing exposure to future chaos. So if you're wondering, how does this connect to silver before it's gone? Here's the connection. When strategic actors secure processing and lock in feedstock, they reduce the amount of refined metal that has to compete in the open market. Over time, that means the available float gets thinner. Thin float in silver is gasoline, because silver has massive paper volume sitting on top of a relatively small physical base. If the physical base gets tighter, the paper market becomes more fragile. It can still paint the tape in the short run, but it becomes more vulnerable to sudden snaps, moments where paper claims collide with physical limits. And that brings us to the next piece, why this story can coexist with violent paper sell-offs. How can governments be building a fortress while the screen price gets slammed? Because the paper market is a different arena. It's a leverage arena. It's a narrative arena. It's where you can flood claims without moving a single bar. But the physical arena is where the fortress matters. And the fortress is what tells you where the long-term power is moving. In part 3, we're going to talk about that split. Paper versus physical. Why a government move doesn't instantly show up as a higher price. And why that delay is exactly what creates the opportunity and the trap for everyone watching the chart. Here is the mind-bending reality of silver. The screen price can drop hard at the exact moment the real world is getting tighter. That sounds impossible until you realize the screen price is often driven by paper flow, contracts, hedges, leverage, forced liquidation, while the real world is driven by procurement, availability, lead times, purity, and guaranteed delivery. The paper arena is fast and violent. It's built to scare you. It's built to transfer positions from emotional hands to disciplined hands. And because silver is relatively small, it doesn't take much paper pressure to create a dramatic move. That's why silver can feel haunted during stress events. It wicks, it snaps, it collapses, it rebounds. People think it's random. It's not random. It's structure. Now, add a government-level reshoring push to that structure and you get a dangerous combination. Strategic demand quietly hardens in the background, while paper volatility increases in the foreground. The public sees the volatility and assumes demand must be weak. Meanwhile, the strategic buyer sees volatility and says, great, we can secure supply without announcing a panic bid. That's how the big players play it. They don't want to pay up publicly. They want chaos in the paper market while they lock in physical behind the scenes. Volatility is cover. And the S, why this headline matters so much. It is a rare moment where the quiet part becomes visible. The government isn't just buying metal, it's trying to restructure the pipeline. That's a different level of seriousness. If you're a paper trader, you can flip a position in seconds. If you're building processing capacity, you're making a multi-year bet that the world will remain constrained and competitive. That is not what you do if you think silver and critical inputs will be abundant and cheap. So what happens next in this kind of environment? Two things at once. First, paper markets keep doing what paper markets do. Sudden sell-offs, stop runs, margin pressure, headline-driven fear. Second, physical markets keep getting quietly tighter. Longer delivery windows, stubborn premiums, strategic offtake agreements, inventory being spoken for before it ever hits the open market. And eventually, those two worlds collide. The collision can take different forms. Sometimes it's a sudden repricing where paper has to chase physical. Sometimes it's a sustained divergence where regional physical premiums refuse to compress. Sometimes it's a scramble where everyone realizes at the same time that exposure is not the same as possession. But the core dynamic is the same. When enough physical supply is locked behind strategic channels, the paper arena becomes more fragile because it's balancing on a smaller base. Now, let me give you a simple mental model. Imagine the paper market as a massive stadium full of tickets. Those tickets represent claims on seats. The physical market is the actual seats. When there are plenty of seats, tickets are stable. But if a large group starts reserving blocks of seats and locking the doors, tickets can still be traded until the moment people show up to actually sit. That's when you find out whether the stadium is real or just paper. Strategic reshoring is the act of reserving and controlling seats. It doesn't immediately change ticket prices, but it changes the future collision risk. In part 4, I am going to give you a practical way to read that collision risk without getting lost in noise, the signals that matter. The signals that Dante and how to avoid getting psychologically liquidated during the volatility that usually comes before a real repricing. If you only track silver through a chart, you're fighting with one eye closed. The chart is useful, but it's not the whole battlefield. The real question in a story like this is, does the physical market behave like the screen price is real? Or does it behave like the screen price is a temporary illusion? So here are the signals you watch when you trying to detect whether a structural squeeze is forming underneath the paper noise. First, availability. Not can you buy one coin, but can you secure a meaningful quantity without delays? When lead times extend and big bars get harder to source, that's a physical signal. Second, premiums. If paper price drops and premiums remain stubborn or even rise, that tells you demand is real and supply is constrained. Third, persistence. One day doesn't matter, a week doesn't matter. What matters is whether tightness persists through volatility. Because if volatility is shaking out demand, you should see physical conditions loosen. If they don't loosen, that means the shakeout failed. Fourth, institutional behavior. Not what they say, what they build. When you see multi-billion-dollar processing capacity being constructed, that is behavior. That is commitment. That is the opposite of this is a temporary blip. It's a declaration that control over critical inputs is becoming a strategic priority. Now, here's the trap for retail. When you see a scary candle, your brain wants to act. It wants to do something. It wants to protect itself. But in markets like silver, the easiest money is made by the players who can hold through the noise while other people are forced out. That doesn't mean never manage risk. It means manage risk intelligently. Position sizing over panic reactions. Avoid unnecessary leverage if your thesis is structural. Understand that paper volatility is not the same as physical collapse. Because here, S what aero S really happening in these moments. The paper market tries to scare inventory loose. The strong side of the trade wants you to provide supply. If you sell because you're frightened, you become the liquidity. And liquidity is what the other side consumes. That's how the wealth transfer works. It's not always a secret, it's just structure. So if this government-linked processing build-out is real, and the direction is what matters, then the long-term implication is not silver goes up tomorrow. The long-term implication is that more supply will be routed into controlled channels and the open market float becomes more sensitive. That means bigger swings, sharper squeezes, more violent resets. This is what happens when a market transitions from abundant enough to strategically sensitive. In part 5, we'll wrap this up with a practical conclusion. What this story means for how you think, how you position, and how you avoid getting played by the exact type of headline designed to make you emotional. So here's the verdict. The headline says panic, but the deeper reality is planning. And planning is more powerful than panic because planning reshapes the world. A multi-billion-dollar processing fortress isn't a tweet. It isn't a trade. It's a blueprint. It's a government saying, we're not leaving this to chance. And when the state treats a metal supply chain like a strategic asset, it changes the game for everyone. It changes the incentives. It changes the flow. It changes where the metal goes. And over time, it changes what price even means because the market becomes less about auctions and more about allocations. That's why this story matters for silver before it's gone. Not because silver literally disappears tomorrow, but because the tradable float can get thinner while demand that can't be postponed keeps rising. And when float shrinks in a paper-heavy market, the moves become more explosive. The paper arena will keep trying to scare you. The headlines will keep trying to hijack your emotions. But the real signal is what gets built, what gets funded, and what gets locked into long-term pipelines. So if you're watching this and thinking, okay, what do I do with this information? Here's the non-hype answer. You stop letting daily noise define your belief. You start watching structure. You watch how nations behave. You watch how supply chains get rebuilt. You watch whether physical conditions stay tight through volatility. And you remember the oldest rule in commodities. The future belongs to the people who can secure supply when everyone else is fighting over leftovers. Again, this is not financial advice, but it is a reality check. In a world moving toward resource nationalism and strategic stockpiling, paper exposure can be a very different thing from secure access. And the biggest players on earth are telling you what they care about, not with speeches, but with billions of dollars and concrete foundations. If you want more videos like this, less noise, more mechanism, Hit like, subscribe, and tell me in the comments. Do you think the next big move in silver comes from industrial demand, from geopolitics, or from a paper to physical snap?